Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Shad here, your hosts for this weekend show. Just a reminder, everyone, please go back to our website, podcast, YouTube channel, and Substack account. Just search the KE Report. That's where you can find all our daily editorials and company updates covering daily market moves, especially in the commodities sector, and all kinds of important company updates that, boy, oh boy, there's a lot of news coming out of the sectors that we follow closely. This weekend show, we're going to be bringing on what I like to think of as a few more generalist guests to focus on what's going on in the commodities, especially the precious metals. Gold this week exceeded $4,000 an ounce. It's a pretty remarkable move that we've seen in gold. And as much as we talk to precious metals focused people, I think it's always good to take a step back and see what the generalists are saying about gold, because we are definitely reading a lot more about this powerful move higher in gold and the underlying stocks. That being said, we are kicking off the show with Peter Boockvar, Chief Investment Officer at OnePoint BFG Wealth Partners. You can also follow Peter on Substack on his Boock Report. I'll post a link in the show notes to Peter's Substack. That's where every day Peter shares key market moves as well as data that he follows. So Peter, starting off with gold, we're recording this on Wednesday. You sent out a morning note to your subscribers that mentioned gold, and you made a couple comments. One that I want to start off diving into. You made the comment that this move in gold is not a safety or uncertainty trade, as we're hearing so many people explain it. Please, Peter, dive into this. Why are you seeing this move in gold as something outside of a safety or uncertainty trade?
Well, the foundation for this gold move started 3 years ago when we know the freeze of half of Russia's central bank reserves caused a panic in the rest of the world who were overloaded in US dollar assets. And that is when the foreign central bank purchases of gold really inflected higher, to the point where in 2022, 23, 24, they bought more than 1,000 tons each year. And in 2025, on a tonnage basis, the trend is a little below that, probably on averaging at about 800, but obviously the price of gold is much higher. So on a dollar basis, it's still pretty elevated. So that's why gold is doing what it's doing. And this last higher over the last, call it 2 to 3 months, is retail investors, institutional investors that have finally woken up to what's going on, and they're piling into the ETFs, and we can see a notable increase in ETF holdings. So yeah, gold, safe haven, uncertainty trade, that's not why gold moves. Gold's another currency. It trades with real interest rates. And now, as I just mentioned, it's trading as probably the most important reserve asset in the world. When you look at sort of that pie of assets that central banks and governments own, gold is now on a value basis number 2 relative to their holdings of the US dollar. And, that gap is going to continue to close. And also you have just the influences of transactions with China and other countries taking place in non-dollar currencies. And gold is also, in a way, a settlement vehicle too. When China buys oil from Saudi Arabia, where they used to do it in dollars, now we're doing it in renminbi, and Saudi Arabia is taking that money and probably buying stuff from China. But can consider any leftovers or settlement can be done in gold, whereas before a lot of excess dollars were just recycled back into the U.S. Treasury market. Also, I want to highlight, and sort of this dynamic is, I think this year that the trade war that the U.S. started with the rest of the world definitely exaggerated the desire to get one's hands on gold, because it basically splintered up the world to the point where foreign investors want to have less US dollar exposure. Interestingly, take the US stock market, for example, foreigners still are overloaded and they continue to buy US stocks. But what they're doing this time is doing it on a very hedged basis. It was like maybe 3 weeks ago. It was a Deutsche Bank research report talking that up to 90% of foreign purchases of US stocks are now being hedged. And about half of purchases of bonds are now being hedged. So, yeah, they still want to invest here, but they're obviously worried about the direction of the US dollar. And they don't want to get caught like they did in the beginning part of the year when they came into the year overloaded on US stocks and were not very hedged.
Well, Peter, there is a bevy of reasons, as you just outlined, why gold has been moving up. I think first and foremost, the central banks buying, as you mentioned. Yes, of course, geopolitical instability that's behind the backdrop, but there's also the BRICS nations, as you mentioned, de-dollarization, using less dollars. But there's also been another one. You brought up bonds. I want to ask your thoughts on this. There's been a couple of big hedge fund and bond traders that have come out and said, hey, the 60-40 has been transformed into the 60-20-20. And we've seen a couple of calls of this in the financial media where before it was 60% stocks, 40% bonds. But over the last couple of years, I think most people have realized the bond bubble popped back in 2020 when we got interest rates all the way down to 0.4%. So now 20% still in bonds, but 20% is being allocated to gold or gold equities. Do you think that that movement has something to do with the continuation of the move?
Yes, and being at a wealth management firm, I can tell you firsthand that we've done that here as well. Rather than just adding gold as another risk asset, it has replaced fixed income, and it's obviously well outperformed it, particularly longer duration fixed income. So yes, that is certainly a factor, but that's more of sort of a flow factor. And I don't know how widespread that is, because if you take the wealth management world that creates these allocations for their clients, I can tell you that the allocations to gold up until maybe a few months ago were not very high.
So, Peter, one thing that I think we should really dive into here is how do we value gold? Because gold, it's not used. It is a financial asset. And we've been hearing about gold at all-time highs in all kinds of other currencies, maybe every other currency prior to this year. And then gold really started breaking out just in the last year and a half. But because it's not used in anything, and because it's a financial asset, which I guess we can balance against other currencies, how do we ever put a value on the gold market and be able to put a target on how high gold can?
Yeah, it's very difficult, no doubt. You can't say what the right price is. We don't know what the right price is, but we can look at the historical relationship in terms of the financial pie of, or the pie of financial assets. Right now, gold is still a very small percentage of those global financial assets. And if it just gets to where, sort of an average that it's been over the past 50 years, gold would go much higher or have a higher value. You can also correlate the price of gold with the enormous amount of increase that we've seen in central bank balance sheets over the past now 20 years, well, call it 18 years. So there is sort of, historical relationships and dots that you can connect to get a sense of where maybe gold goes. But again, this is not a science, and obviously you can't do a discounted cash flow analysis on the price of gold. But there's still some back of the envelope sort of methods one can use to get a sense of where this bull market may eventually end.
Well, Peter, I think the other metal we need to talk about in tandem with gold is silver. It's a little different in that most central banks are not accumulating it, although there are three or four that have come out and vocally started accumulating silver along with gold. But silver is in a wild move really over the last couple of months. It's getting close to that 1980 and 2011 high of $50. You noted this morning to readers that as it's knocking on those levels, it's still well below its 200 inflation adjusted high. So if we adjusted out that 1980 high to today's dollars, silver would still have a lot further to run. It hasn't made an all-time high like gold has over and over again the last 2 years. So what's your take on silver?
Yeah, no, that's absolutely right. There's a lot of catch-up potential. Silver is just this very unique asset in the sense of it having gold-like characteristics in terms of its monetary characteristics and historical currency characteristics. But on the other hand, half of the demand ish, give or take, is obviously industrial. And now, everyone every day, every minute of the day talks about the AI build out. Well, silver is a needed commodity within that build out. Then you throw in the deficits that we're seeing from a supply demand perspective, both last year and this year. And it's just a very interesting asset. Again, different than gold, since gold, most of its use is not industrial. And so silver is, and we know that all the gold that's been mined is above ground, where silver sort of gets used up and not fully recycled. So it is unique. And as you said, whereas gold has exceeded its 1980 inflation adjusted high, silver is nowhere close to that. And platinum is even further behind.
We'll get into platinum, but just to follow up on silver, where do you stand on that whole argument in terms of what will drive price, the precious metals or the industrial use? Simply because it seems like this, or at least the most powerful moves, can come on the back of the more precious metals standpoint. But industrial uses, is there a risk that if the price gets so elevated, if it does get up to $200 an ounce, that less silver is used industrially?
Oh, there's no doubt that at some price it will break demand. There's no doubt. I think the next leg higher in gold is, I'm sorry, in silver is certainly going to be piggybacking this move in gold. I mean, because that's what usually happens. The industrial demand for silver is not going to move the price like a monetary move would do.
Well, and the other thing we should discuss in tandem with gold and silver is the gold and silver stocks. I mean, we are seeing some capital funds start to allocate into the gold equities and the royalty companies and the silver stocks. And we've actually seen the little guys, Peter, even the juniors that we follow on our show, have really hit the rocket fuel on the last year or two, but especially the last couple months. And September was a bang up month. We also just had the highest average quarterly prices for gold and silver. So the producers are printing money at these levels. I think the earnings season is going to be pretty exciting. What's your take on the gold and silver equities?
So yes, finally playing catch up. I mean, we know, you guys know better than anybody, the difficulty of this business and the destruction of capital that the industry has seen over decades. But there were fortunately, some learning experiences from that, and from a balance sheet perspective. And these companies were all set from a cost perspective as well for an eventual rise in the price that would fully leverage what they put in place, and they're now reaping the benefits. I mean, there are two types of people that have redefined the word patience. One is those that are waiting for the Bank of Japan, that have waited for the Bank of Japan to raise interest rates. And the other is a gold mining investor, because without patience, you'll never make it in this business. And finally, that patience is paying off, because a lot of the increase in price is falling directly to the bottom line, because a lot of their costs, which have gone up tremendously over the last 15 years, now is not rising in tandem with the price of their product. So the margin improvements are just dramatic here.
Well, going on that, you're right. 10 years ago, people were talking about gold being priced at the price of production. And even though the price of production has gone up quite a bit, the gold price has gone up so much that it would take 50% correction, if not more, in the gold price to bring it back to that price of production. So the margin is widened so much here. But Peter, we haven't exactly seen more gold being produced. Do you think that's a lagging factor? Do you think we are going to see more gold being produced year over year as prices seem to stay at these high levels?
Well, we know that any high cost project becomes more attractive in a high price world. So, that alone will probably bring more supply to the market. But, it all depends on where the jurisdictions are. You can't snap a finger and start pulling gold out of the ground. I mean, we know from our own experiences researching these companies is that it takes many, many, many years to prepare a mine, well, to explore for the actual stuff, and then let alone actually building a mine to get this stuff out. So, and then, you also, there's always issues in mining. And you look at the copper market, you look at Freeport, who has had declared force majeure because of the accident there, and issues in Congo with Ivanhoe. I mean, it's just a really tough business. And I know the estimates that are broadly speaking out there of maybe 2% supply growth in gold over the coming years. I don't think that will change much, even with this big price increase, again, because it's just very difficult bringing this stuff online.
Well, Peter, I don't know how granular you get down into the development stage companies, but the other big divorce we're seeing in valuations is that an ounce in the ground of gold is being valued at, let's say, between $30 and $80 an ounce on average on these projects. And yet the margins the producers are making are around 1,500 to 2,000 for Q3 is what we expect to see. There's such a big delta there. How do you see that part of the market changing? Do you think more investors or more analysts will wise up to the value in the ounces in the ground?
I do. This bull market is not ending until the juniors are in a frenzy, until silver is more than $100. I mean, that's how these things end. And I don't see this being any different. I mean, when you think about sort of the progression of a bull market, I think up until a couple months ago, it was okay, yeah, gold's doing really well. And it was a lot of sort of commodity type investors, putting aside the central bank buying a physical, I'm talking about from a sort of an equity ETF perspective. You had a lot of people like us that have been positioned and waiting for this and probably adding more. But it's not until gold starts to break out that you started to see people paying attention to. When I say people, I'm talking about the average person, the generalist, the person who watches CNBC but never bought a gold stock. And we know sentiment follows price, and that's just human nature. And so then when you think, okay, yeah, when you call up your advisor, your broker, I think I want to buy a gold stock. Well, that person doesn't know anything about gold. What are they going to do? They're going to buy either, GDX, the ETF, or they'll buy Newmont or whatever, like Nico even, and that'll be their gold exposure. But as this continues on, as prices not only continue to rise, but at least stay elevated, because that's the key, right? There's one thing to have a price go up. It's another thing to have it stay there, because you need it to stay there in order to reap the financial benefits of that. If it's a fleeting spike, well, you can't sell enough product into that. So as long as it stays here, that's when you get people to widen their lens of investment opportunities. That's when they start buying anything with the word gold in the name of the company. And, that's where the speculative juices really start going.
Peter, what does a top look like then? You started to give some insights in that the juniors running higher. We have seen the juniors really start to run higher. If you pull up a 1 year chart of these juniors, it looks very good. But you go back 5, 10 years, if they've been around for that long, and some of it hasn't even really moved when you look at just how much dilution they've taken on. So what does a top in the gold market, especially, but even silver, I guess, look like?
I can answer that more from a chart perspective rather than a fundamental perspective. When these things get parabolic, we know how parabolas end when it comes to an asset, regardless of what that asset is. So now, even within a parabolic move, something can go from 50 to 100 to 200 to 400, and you could have said, well, 200, it's going parabolic. So it's very difficult to say. A lot of it's going to be feel. A lot of it's going to be, can you spot when things get frenetic? From a price perspective, I've seen arguments for 5,000, 10,000, 18,000, 25,000. They're all over the map. I will say that none of us are going to be smart enough to know the answer to this question. We're going to have to sort of feel our way through and be smart enough to sell on the way up rather than trying to get cute, trying to pick a top that you may not be able to make and then having to sell on the way down when this thing reverses.
Some good thoughts there for people to consider as this plays out. And yeah, we don't really know where it's going to be, but it's curious to at least get the thought exercise out there of what a top would look like. But we can say it's nowhere close right now. We can say that copper, you brought up the force majeure over at Freeport in Indonesia at Grasberg and the problems that Ivanhoe had in the Congo. But there's a lot of AI buzz that leads into the copper story too. So just like the AI buzz leads into silver, same thing for copper. And it's above $5 a pound right now. Again, this started back in the Ukraine war, and it's happened a couple of times. And now it seems like more and more people are just getting used to a $5 handle on copper, but it has that longer term supply demand fundamental growth trajectory. How are you looking at the red metal?
Yeah, no, it does. And I think the demand side is pretty consistent. I think and generally speaking with a lot of commodities, it's trying to figure out the supply side is usually more difficult than predicting the demand side. So yeah, copper looks with like a great setup here. And it's those supply disruptions that I think wake people up to the fact that there are imbalances there as well. I know, like, putting aside these temporary mine issues, I don't think that the supply side is as tight with copper as it is for other metals. I wasn't as, even though I was bullish on copper, not as bullish compared to other things. But when you see the Grasberg, as you mentioned, and Ivanhoe and some others, it does wake you up to the fact that, there's an interesting dynamic there as well.
What do you think about the copper stocks? Some of the big boys have moved, but boy, oh boy, we're hearing a lot of the little guys and even some of the more advanced, right now, still small cap stocks not getting any love. It almost feels to me like what we saw with gold a few years ago when gold started breaking out. And yeah, some of the majors were moving, but the sector just broadly wasn't. Is the same setup happening here in the copper stocks?
It's possible. I mean, maybe it's in response to, these mining issues, as we're all reminded at how difficult this business is. Maybe it's jurisdictional in terms of the names that aren't getting anywhere. We do know that as the price of commodities go up, governments get more greedy and they want a bigger slice of the pie. I mean, look what the Indonesian government's done to Freeport over the last bunch of years. So, but again, if prices stay high, and also another thing is, to my point earlier, with coppers or just commodity prices generally, you need them not only to rally, but you need them to stay up. And maybe copper equity investors are not confident that copper is going to stay at 5. I think as the weeks, months, quarters go on, and it stays there, and these companies start to generate attractive cash flow numbers, well, then they'll re-rate. But it's a lot of times I've been burnt before. I'm going to wait and see, and that's the mentality similar to the way that it was for gold mining stocks up until this year.
Well, Peter, I want to also open up all these other metals that we hear about that are really critical minerals, and they get their moment in the sun, but they've also got a lot of attention from this administration as far as different executive orders, things that were put in the bill, both the Biden administration's Inflation Reduction Act that had a lot on development of critical minerals and Trump's big, beautiful bill. But yeah, executive orders on not just copper, but things like uranium, things like antimony, rare earths, and tungsten. And we've seen the Department of Defense investing in tungsten companies, antimony companies, rare earth companies directly. I don't think we've ever seen that before, the government taking stakes in these companies. So any thoughts just in a loose sense of all of the attention from nuclear power all the way into the critical minerals?
Yeah, it's pretty amazing to see. These are right now with sort of a splintering of the world, in a sense of China and us getting our hands on these things to drive this sort of, I don't want to say new economy, but the economic growth that we want to see in AI and all these other things that need these critical minerals to function. You need, in order to build a car, you need magnets. In order to build a defense system, you need magnets. So yeah, it's a race to get your hands on it. Now, we can quibble with how the U.S. government's going about this by playing venture capital. I'm not a fan of that, but it's just, I think, highlighting the importance and the rarities of a lot of these metals.
Yeah, it really is. So much has been on the refining space too, but it's just interesting to see the government getting behind or at least investing in some of these companies and then the moves that we see on the back of those share price wise. You mentioned that you're not a big fan of the government doing this, but what does it mean for the longevity of these markets? Because will the government stay friendly to them? Is this going to lead to easier permitting, or is this a short-term thing?
Well, the interesting thing about the deal this week where the U.S. government invested in Trilogy, it's a Canadian company. So the U.S. government's not going to have any influence on the permitting and, maybe through negotiation. But, that was an interesting sort of dynamic where they bought a Canadian company instead of a U.S. company. I don't know. I'm never a fan of government stakes, but I think it's more symbolic than anything.
Well, and Peter, there's also been decades of subsidizing of agricultural farms and products, which you could argue is interference in markets, but they did the same thing. The Obama administration famously got involved in a lot of solar companies, and we're seeing this administration get into tech companies and chip companies and everything else. And so, yeah, from a market intervention standpoint, you don't want to see it, but from a investing standpoint, isn't it nice to see some support of the mining industry that's been dogged for decades?
There's no question. It definitely brings attention to the space, brings capital to the space. It highlights the uniqueness and the rarities, as I said, of this and the importance of it, and the difficulty in accessing them and not being reliant on somebody else that is not as friendly to you. If rare earth magnets were being produced in Mexico or in the UK or even in Japan, I don't think we would be getting crazy about this. But because of China and our current relationship with them, there's obviously an obvious desire to be more in control of your destiny with that.
All right, Peter. One other commodity sector or resource sector that we should talk about that hasn't been running. So maybe an opportunity here is energy. Old school energy, especially looking at oil and natural gas. They have been stuck. Oil, arguably in just a kind of grinding downtrend. Natural gas, again, just kind of range bound stuck. A little bit better price than last year, but really not that exciting. And the stocks, they seem to still be able to make money at these pricing levels, but they're not investing in growth. We see low rig counts, but still high production out of the US. With all the other commodity sectors running, why are oil and natural gas lagging?
Well, I think there's concerns about the demand side. I think there are also everyone's obviously paying attention to OPEC and seeing what they will do here. They took back their 2.2 million barrels post-COVID cut, and now they're chipping away at the 1.65, but they're doing it methodically. I think the offset is this moderation in shale, U.S. shale production growth, that 85% of all non-OPEC supply over the past 25 years came from U.S. shale. And if you look at oil production numbers, they're sort of flatlining this year, and I think it's very possible that it actually drops next year. You mentioned the rig count. Well, the rig count's hovering near the lowest level since September 2021, I believe. So I'm actually very bullish on oil prices. I can't find a bull out there. Everyone's bearish. Everyone is talking about we're swimming in oil and OPEC is swamping the markets. But I think what we're seeing with OPEC is that their actual production increases are not meeting the quota increases because a lot of them are already maxed out. And there are only like two countries, Saudi Arabia, maybe the UAE, that has much spare capacity. And to your point about the oil stocks, I mean, a lot of them are making money at $60. So you can make money on what I believe is the lower end of this down cycle. Imagine the money you're going to make when things turn up. And I think that eventually is going to be the case. You can buy plenty of oil stocks with great dividend yields. And imagine if oil went back to 70, 80, or even $100 at some point, which I think it will. I mean, and an inflation adjusted basis, price of oil is dirt cheap.
Well, just to that point, Peter, you can buy quality on sale right now, even the biggest producers, but you can also buy growth companies that are in the penalty box just because of where the oil price is, but they're still doing pretty good as well. And then there's also the oil services. So just a question for you, if you had to hedge your bets or maybe do some percentages and you were just doing an oil allocation, would you put it in the large dividend payers? Would you put it in the mid to small cap growth, or would you put it in oil services like the pipelines and the drilling companies?
I would do a little bit of each, to be honest. I think all will benefit from a rise in prices. That's what we've done. We're long some of the big ones that pay generous dividend yields. We're long like Noble in the offshore drilling space. I think the whole space, the whole energy space in terms of its contribution to the S&P is like 2.75%. It's almost nothing. So I think you can buy all those stocks and you'll end up doing well.
All right, Peter, we'll wrap it up here. Again, Peter Boockvar, Chief Investment Officer at OnePoint BFG Wealth Partners, also editor of the Boock Report on Substack. I'll post a link to Peter's Substack in our show notes, so everyone visit our website, podcast, or YouTube channel to be able to click on that link. Peter, always great chatting with you. Thank you so much for taking time with us. I hope you have a great rest of your weekend. And everyone, stick around. We're going to be right back with the second half of the weekend show.
Thanks, guys.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report and continuing to focus a bit more on the metals, especially precious metals, with more of our generalist commentators. We're chatting right now with Dana Lyons. Dana is a fund manager and the editor of the Lion Share Pro website. We chat with Dana about every 2 weeks to really just get an inside look at a wide range of markets, whatever Dana is trading and whatever his models are telling to him. And Dana, we're recording this on Thursday, which is unfortunately not a very good day for the precious metals, where we are focusing this weekend show. We're seeing gold, after exceeding $4,000 an ounce, now down by over $100 on the futures market, just below $4,000. Silver has been down today almost $2 after closely touching $50 an ounce. The stocks, they're all moving down pretty aggressively as well. One of the major things we've been talking about on the show is trimming some of the winners, especially in precious metals. A lot of our audience hold precious metals stocks. We get a lot of pushback from that because, look, it's a bull market. Everyone likes to ride the bull market higher. Before we get into how you're trading all this, let's just get your assessment of this one-day move. It's a correction for the precious metals, gold and silver. What are you seeing out there?
Yeah, right. Thanks, Corey. Well, we're seeing a big pullback today within you have to keep perspective, within a massive, or following a massive up move. So looking at the miners, for example, since, bottoming in April or launching in the March, April period, pretty much the miners across the board, just the general ETFs, whether it's gold, silver, copper miners, they're up on the order of 100% or more. So to be surprised at a retracement means you probably haven't been in the markets very long. So to see that maybe the percentage move in a day is alarming, or the fact that, looking at gold specifically has gone up so much that it's at such a high price level that the price moves seem a little bit more alarming now. It's like looking at the Dow, it's at whatever, 40, whatever thousand. Back in the day, I remember starting out in the business, a 100-point move was like massive. It's all a matter of perspective on where the price levels are and how far they've come. So right now, after such a massive move in the metals, even just a small percentage retracement could be a big price retracement. So just looking at GLD, for example, we're up about, I want to say maybe 140 points or so on GLD just since the beginning of the year, early spring. So it's had certainly a massive move. So the first real support, trading around 370 something. The first real good support I see is like 330. So I could say a massive, or you might want to call it massive, be like a $400 move in the price of gold to what I would consider the first like real decent level of support. So it sounds like a big price move, but I wouldn't be surprised to see that move. It's only, a quarter of a retracement based on what we've seen since early in the year. So it's all a matter of perspective. And it's one reason, and we talked about this a couple of weeks ago, I really would guard against chasing moves ever, whether it's breakouts or any type of a FOMO move higher. You got to pick your spots. And honestly, if you do have FOMO on a market that you missed out on, just go move on to something else, because the worst thing you can do is chase it, and then you have this big retracement move like today, and maybe it continues for a couple days or weeks, and then you're really stuck. Whereas, okay, if you've been in the position all year, it's not the end of the world, especially if you've taken some profits along the way. So you got to really pick your entry points carefully, and then also, as we talked about last time, take some profits if you have parabolic moves in some of your positions, windfall profits, we call them, whether it's at fib extension levels or sometimes just an arbitrary level because your position has grown relative to the size of your portfolio a little bit more, then just take some off the table, and it makes it psychologically easier to hold the rest of the position.
Yeah, Dana, let's even dig in further on this topic of taking windfall profits because psychologically, you know that you've booked some big gains. You've got some dry powder on the side that you could technically buy back in if you wanted to at a certain pullback spot. But also, it's easier to hold on through the duration of pullbacks if you know you've already harvested. We brought up, and a number of our guests have brought up, that in the precious metal sector, not just the gold stocks, but the silver stocks too, they've really had these big moves, some of them up 200, 300, 400%, that maybe you should trim some winnings. And you'd think by some of the comments that we're talking about shooting the family dog. They're like, why would you do that? How could you consider taking profits? And we were talking off mic about the move in silver today. Silver got up and pretty dang close to $50, the all-time high from 1980 and 2011. It got to 49.95 on the futures and then dropped to 47 in a couple of hours. And there were people that were saying I may put a sell stop in at 49 just to harvest some gains, and other people berating those people. So talk a little bit more about harvesting windfall gains and I guess the psychology around pulling some off the table when you've had a big move.
Right. Well, as they say, you never went broke taking some profits, but the other side of the coin, and I understand folks saying, why would you take money off the table when it's in an uptrend? There's no sign of a reversal. I would say when you have what I would call windfall gains, parabolic moves on the chart, like we've seen in a lot of the miners, a lot of the metals, it's nice to have some sort of a mathematical or quantitative reason ahead of time for where you're going to take some profits. We like to look at Fibonacci sequence. So whether key retracement levels from the prior highs back in silver's case, SLV, a couple decades ago, or to new highs at Fibonacci extension levels. So some mathematical spots where prices tend to move and maybe get a retracement from. So if you do hit those levels, take a little bit off the table. Like I said, when you get those windfall moves, taking a little bit off the table doesn't materially change your position necessarily, because you might have started with a 2% position in your portfolio that thing goes up 100, 200%. All of a sudden, it's like 3% of your portfolio. So if I'm comfortable with only 2% of the portfolio in a position, trim a third, take profits on a third. You still have 2% of the position. And like you said, it makes it psychologically sometimes easier to ride through the subsequent ups and downs with the rest of the position. Even, mild retracements like we're seeing right now, even though they're big dollar moves, they're only mild retracements. And if you're taking some profits along the way, it makes it easier to hold with the rest of it. And like you said as well, we're still obviously in a strong uptrend. And if the mega bullish people are correct in their narrative, there's no rule against getting back in on a retracement at a better entry point, closer to maybe some good stop losses. So looking at, let's call it gold, for example, or GLD, like I mentioned, if we pull back towards that 330 level, it'd be equate to like a $400 drop in the price of gold. That's a better spot to get in. And then if we break down through that level, okay, now I stop myself out on that position, as opposed to, okay, I've got a small loss on that recently added position, as opposed to taking a $500 loss on holding the whole position all the way down. Now you're breaking like real support. So it just managing the risk in the shorter term helps really maintain that longer term position, as long as in the long term you do have a continued relative strength or continued uptrend, well established in those positions.
So Dana, if people are trimming, the one thing that you always ask is, what are you going to do with that money? Because there's always opportunities. There's limitless opportunities. And a lot of the time, you see people simply recycle those profits into similar stocks. What do you do if you trim a little position for whatever reason. What do you do with that cash?
Right, and it depends on a number of factors. It depends obviously on our read, specifically looking at our models, which are based on the equity market. That's our core model, would be a risk model in the equity market, and depends on our modeling on the overall market. And if it's still bullish, then we're looking to for other opportunities to roll that money into that are not quite as extended, that still offer maybe some more immediate to intermediate term potential than running out and chasing something that's up 200-300%. And then perhaps we're getting in some red flags. Maybe we think the market's long in the tooth. We're getting some warning signs from our models, and maybe we just want to keep it in cash and see how the market responds to some of these red flags or some of these chinks in the armor, so to speak. But so specifically right now, our main risk model is still bullish, as it has been for over 5 months now, but obviously after quite a strong rally off those April lows, especially in something like the metals and the miners, for trimming some profits there. We want to look for any new allocations. We want to look for perhaps examples of new relative strength. Okay, areas that are just emerging in terms of the relative strength, and they're not quite as extended. So you have better opportunity, better potential here in the near term, like I said. And at the same time, they're much closer from an entry point standpoint to maybe some levels that you could gauge a better stop loss, where you don't get nicked as much by buying at these levels. So right now we're looking at areas of new relative strength to allocate to, with our models still bullish. We don't want to get too defensive right now, but obviously we don't want to chase things that have already run parabolically.
Well, just to that point of rotating into potential new relative strength, any other areas of the commodity sector that have your interest? Like we've noticed a little uptick recently in copper. Uranium stocks have been doing good. Rare earth stocks have been doing good. Any other sectors of the commodity or resource stocks that are tripping your trigger right now?
In commodities or resources, not as much. All the metals, all the miners have run so much. I would group them kind of in the same category. Uranium and nuclear also probably not as extended, so we do still like those areas a lot. As far as the commodity space, I would say that's probably where we're mostly concentrated, not as much looking for new allocations in that space unless we get more of a pullback. If these miners pull back more substantially to better entry points, then we'll increase our allocation back. Same thing with the uranium. We have no problem increasing our allocations, but you have to take some profits along the way at those extension levels in order to put some back into the market. So that's pretty much where we're at in the resource space right now.
Dan, I'm curious to that point about still having the models be bullish, but then potentially trimming some of your position. What about hedging a position so that you still have your full position long, but you can, I guess, still profit a little bit from a bit of a pullback? But again, you're still in a bullish narrative with your overall position.
Sure. We like to hedge when our model is maybe weakening or deteriorating and we're seeing potential for a turn lower, or we're seeing a specific sector or segment of the market that looks vulnerable to moving lower. And if we do have a reversal, maybe we get a head start on that move lower. And in terms of hedging the same sector that's run so much, I don't like to take that tactic, because then if you're, for example, long and short gold miners, then now you've got like two decisions to make. Where do I stop my shorts out? And then on the downside, what if we break support? Now am I blowing out my long position as well? So we do like to, like I mentioned, we do like to use hedging strategies in the broader market in general, rather than, just hedging a specific a specific sector or market segment just because it's run so much. And I would say right now we're not at that point yet. So right now we'd rather raise cash in some areas that have gotten extremely extended. And then if we end up with a decent amount of cash, substantial amount of cash, but our models stay bullish into a pullback, then we can deploy that cash again rather than, having to make a both long and a short call.
Well, Dana, I hear what you're saying about having to make two decisions instead of one, and that complicates the process. But we have had some people emailing in questions like, hey, I'm long a basket of mining stocks. Should I short the GDXJ with options, or should I use an inverse ETF like JDust to short the GDXJ just to hedge my long positions? I know that's involving the two decisions you just talked about, but would you be more likely to use options to short an index, or would you be more likely to use an inverse ETF to do it if you were going to put on a hedge like that?
If I'm bearish on something, I'll use an inverse ETF. If I want to stay long something, but I think maybe volatilities become extreme, or I think maybe it's time to cool off or we consolidate for a time, then probably utilizing the options in my mind would probably be the best way to go.
So, Dana, as much as everything's still bullish, we do ask a lot of people what a top looks like then. You've outlined what a normal correction would be in a buying opportunity, and I realize only time tells when there is a top, but what would a longer term top or a general market change in terms of bullish to bearish look like for the precious metals?
For the metals, you're probably going to see some sort of divergence, some kind of divergence. If it is a classic bubble, you might not see a longer term divergence. You'll have the parabolic move and then a subsequent crash right away. But maybe if you're looking on a smaller time scale, you might find some momentum based divergences along the way if you really break down the duration. Within the overall market, though, what we would be looking for in the equity market in terms of a market top are divergences among the internals. So when the broader market starts to break down and some of the broader averages start hitting lower highs, even when the large cap averages continue to move to new highs, then you're starting to see some substantial cracks in the foundation of the market. And like I said, we're not seeing anywhere close to that right now. We're still seeing a lot of broad indicators, a lot of the internal measures hitting new highs, I would say. Obviously, there are some averages that have not hit new highs. The value line geometric, for one, mid cap average has not hit new highs. Russell 2000 has challenged the former highs. I do think that goes to new highs before it's done. So there are some red flags out there, but in terms of anything that we would label significant in terms of a major longer term top, we're certainly not seeing any of those signs yet.
Well, Dana, I know that if you had pulled cash out of any sector and you were waiting for a place to buy back in, you're going to be leaning most heavily on your quant models for some of those criteria to change yet again, but on the opposite side. But if you were just using technical analysis, if you just put your technical hat on and you didn't have access to your quant models and you were looking at things pulling back, you've mentioned Fibonacci retracements as one technique. Would you ever use something like previous lateral price support as an area to buy in, or do you ever use moving averages if they go down and tag a key moving average, or are there any other tools in the arsenal that you would use as far as scaling back into a position? If you pulled profits, you were correct, it pulled back down, where would you scale back in?
Certainly all of the above, especially if there is a particular level where you see a confluence of several of those charting techniques, lateral support, especially if it's a major breakout level or a major launch level. Like we're seeing, there's no shortage of examples in terms of the miners out there, major breakout levels. And then, like I said, if they correspond, for example, with some key Fibonacci retracement levels, and we'll look at a couple moving averages as well. It's not at the top of our list, but certainly there is significance to those. So yes, we will look at all of the above, and like I mentioned, those levels where you're seeing, a confluence of several of those indicators, especially what we've noticed in the past, if you're seeing a confluence of Fibonacci retracement levels from different lows historically, those tend to be the strongest types of signals. So those would be the types of things we're looking for in terms of buying dips or scaling back in.
Then I find trading in the metal so interesting because it's not like tech where there's a price for tech, but there is a price for an ounce of gold, and then there's all these equities underneath it. One thing that a lot of the people in the sector, in the precious metals or resource sector, say in general, is that you can get an understanding of where the metals price is going by what the stocks are doing. If the stocks are moving higher, if they have rebounded, then they're telling you that the metals price could go higher. I don't always believe this. I find it's a fleeting kind of excuse, but it can give you a bit of a feeling if I guess the retail audience or more risk on investors are coming into a sector, if they're going into the stocks and even the smaller stocks. How do you feel about that argument for trading something like precious metals where you do have the stocks as potentially a leading indicator? Are they a leading indicator in your eyes?
And there are certainly more qualified people than I just to speak to this relationship in the resource or the metals markets in terms of this comparative analysis. I've found in the past, and we've discussed this in terms of like intermarket analysis, which can be helpful at times, but at other times it's completely unhelpful, or you have, inverse relationships to what is the standard thought of relationship. So I would say in terms of that comparative equity versus the commodity type relationship, maybe it can be helpful, but there are probably, you can have long stretches, maybe a decade where it's wholly unhelpful. So personally, for me making investment decisions, I have a hard time outlaying, capital based on some of those, relational type metrics. And sitting there for years waiting for those metrics or that relationship and that narrative or thesis to take hold. Even if it's taking hold right now, I would have had a hard time sitting, over the last several years waiting for that type of move to happen.
Well, Dana, I appreciate you humoring us on some of these commodities questions and even ones like intermarket analysis where it's not really your bag, baby. But what is your bag is your quant models and looking at what you're seeing. And so let's open it up maybe more broadly now to when you look at your models right now, you're always looking to position and rotate money into areas that could be the next relative strength. When you look across the broad spectrum of different market sectors, any areas sticking out to you as ones that you want to participate in now that are maybe emerging as new strength?
Yeah, absolutely. And we've talked about various areas, various markets across the spectrum over the last couple months as the equity rally has become long in the tooth. We talked about China a couple months ago that we thought was just emerging and has run a bit, and we think there's plenty left in that opportunity. We're seeing Japan has recently made another breakout and maybe could be certainly added to into dips. And one other sector over the last week that has caught our eye, and we've added a new allocation to that after basically going sideways for half a decade, is biotech. It has not participated much in the rallies, like I said, over the last 5 years. It is rallied, it's up quite a bit off of the April lows, but it took a while to get back up to all-time highs. And like I mentioned, just over the last week, we've seen finally a breakout in some of the ETFs and some of the biotech averages finally above all-time highs that were set, about 5 years ago. So that is one area of potentially new emerging relative strength that has better potential right now and that we've had an allocation to just over the last couple of days. And again, it's something that we can stay disciplined to our risk model, which remains long, and yet not reach out via the FOMO stick on something that has already run quite a bit, as are already extended. It has much more potential right now. And like I mentioned before, it's much closer to any sort of major support that which a break would maybe or would offer us a much closer stop loss point. So biotech would be one area I'd be looking at. And then just today we added some more allocation, and this area, the Ethereum has already run quite a bit, but I think after testing the former highs and consolidating here for a little bit, I think it has a lot of promise in terms of potential new breakout to all-time highs and a new up leg there. So Ethereum's something that we added a little bit more allocation to today.
All right, Dana, we'll wrap it up here. Very good insights. Very interesting to hear what you're trading. And yeah, thank you very much for going down the precious metals rabbit hole with us. There's just a lot to talk about in the precious metals sector with the crazy moves we have seen. And now on Thursdays, we're recording this, the pretty big pullback, but again, in a bigger context, still not really much on the longer term chart. We'll see where this all leads. Again, Dana Lyons is a fund manager and editor of the Lionshare Pro website. Click the link in our weekend show posting to follow along with Dana. And everybody, thanks for tuning into this weekend show. Be sure to go back to our website, search for our podcast in whatever podcast player you use, and search for us on YouTube by searching the KE Report. It's where you can find all our daily editorials and company updates. Everyone, and Dana, I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.